Good morning, class. Welcome to this session of Strategic Financial Management. In our today's class, we shall begin with a new chapter, that is chapter number 3, Capital Structure. Now, we have already done with the 4 of the chapters. The first one was the Introduction to Strategic Financial Management. Now, there are many aspects that we have already discussed in that particular chapter, which are also concerned to uh, this particular chapter. So, it is better, if you all try to remember the topics that we had discussed in our first chapter. Now, speaking regarding capital structure, as the name suggests, we are trying to understand how the capital in every organization is built of, or what are the components of capital structure in every particular organization. Now, this is to tell that every business organization needs money to start, right? And especially when we are studying or discussing strategic financial management, we are with the view that we are trying to understand the corporate structure. So, whenever we speak of corporate structures, definitely the money that is being involved would be in crores of rupees, and hence most of the times it might not be possible for one particular individual to invest all the amount that is necessary for building the capital of the organization. Not only that he cannot invest so much, but also from other aspects or from the ease of doing business, it is better that people go in for corporate structure. And having said this, now what might this capital consist of? Or, uh, what are the components that makes up the entire capital of an organization? What things might be there? Now, one more thing I'd like to tell is that the points would be definitely given in your PPT, and the same points would be there in your handouts also. But if at all you need the explanation, you'll have to take it down as and when I explain. I will be, you know, in that speed wherein you can take down the explanations. So it is better that you maintain a note. Although you would be given out with handouts, when you maintain your own notes, it will help you to understand things better. Now coming back to your subject. Now, mainly your capital of any organization is made up of, first one is equity, the second one is debt. Now, these two makes up the entire capital of an organization. Now, having said that, it is not necessary that both the aspects must be present in the capital of an organization. There can be some of the organization which can be built wholly on equity. then there can be some of the organization which can be built only on debt. So I would like to tell that please do not unmute yourself. Reshma, please do mute yourself. Yes, now this is what happens when you disturb the class. Please, students, see to that you do not do any such things which might be of disturbance for your entire class. And it is not the first day that you are attending the online class. It's been a while, so please take care of some of the things that you will have to do, right? And once again I like to tell this because anymore you'll have to be a little bit attentive for what is being discussed. So please do not keep your mic on and do the rest of the things. If you are not interested in listening, then please do not attend at all. Now having said that, now the capital generally is made up of either equity or debt, or it can be a mixture of both. Now, when we speak about equity, definitely it is nothing but the equity shareholders. Now speaking about the equity shareholders, it can be the ordinary equity, it can be the preference shares. When we speak about debt, there are a lot of options. We can buy from individual, we can get it from some of the institutions, we can also take it in the form of debentures or bonds. There are many ways. So there are different kinds of uh, capitals including which we can build the capital of our organization. Now, that is the one part of this capital structure. Now, uh, before moving any further, speaking regarding capital, now in very simple terms, we can tell capital is wealth, right? Now, capital represent that wealth which is used in creation of additional wealth. Now that would be the main aim of any individual or any enterprise which involves in business or which does the activity of investing. That is, by investing we try to make some more wealth for the organization. So you can take down capital is wealth which is used in creation of additional wealth. Now, and also, it goes without telling that every organization requires fund. Now, that is the one main characteristic of any business, that it needs funds to do anything, to start doing. It can be a service industry, it can be a industry which, I mean, organization which produces goods, can be consumerable goods, or it can produce any kinds of services. No matter what it is, or for that matter, even it could be an NGO. Now, every organization requires fund. Now, having said that, now this fund can be of two types. It can be short-term funds, it can be long-term funds. Now, there are some of the organization for which the short-term funds would make the major proportion of the capital, and the long term would be the least in the proportion. And the case can also be vice versa. That is to tell, now if at all organization is into the business of constructing, might be a dam, the roads. Now, such organization, for them investing in fixed assets would be more than investing in current assets. Now, if at all there is any organization which is into doing some day-to-day activities, in those cases they might require more of the short-term capital than that of the long-term investment. Now, this is happening more with the upcoming online business. Now, when it is online business, the investment on fixed asset is decreasing, but then they would require day to day money for doing business. Now, when we speak of capital structure, we tell that a appropriate combination of fixed assets and current assets are to be made. Now, every business organization or the firms, now they are expected to follow a crucial, or in financial words if we try to tell, a prudent financial policy. Now, when we speak of this prudent financial policy, it tells that a considerable amount of importance should be given for the future. That is to tell, it is not that I solve the problems of today, but then while solving the problems of today, I should also give consideration in thinking what might be the possible problems that might appear in the future, and how would I face it. So if you want to take down, you can take some of the points. The first one is, the first one was, capital is wealth which is used in creation of additional wealth. The next point you can take down is, every organization requires funds for doing business, both short term and long term, and appropriate combination of fixed assets and current assets are to be maintained in an organization. The next one you can take down is, firms are expected to follow a prudent, or PRUDENT NG, a prudent financial policy. Now, prudent is nothing but wherein you would give more consideration to the future thought also. Now, moving forward. Now, these current assets are nothing but your short-term capital. Now, your fixed assets are nothing but it represents your long-term capital. Now all these things are in chain. Now it is not that if I tell only fixed asset, it is only representing the fixed asset. As soon as you hear the word fixed asset, you should remember that it belongs to the long term capital also. Now for current assets, when we tell, it can be short term capital, it can be working capital. Now all these things should always be you know there as a point, so that whenever you have to answer, you can make your own answers in a better way, and you can maintain a very small notes for that manner. Now continuing with the chapter. Now there are two things of an organization. One is strength, another one is profitability. Now, when we tell strength, it is nothing but the financial strength of the organization. That is to tell how well can an organization arrange for its fund. If at all today to do a big project, if it needs huge amount, now, whether it has such credit worthiness that anybody outside the organization would be willing to invest in the organization. How well would the outsider invest in the organization? Or if at all today a sudden need for a huge amount of short-term capital might also arise. If that is the case, how fast can an organization arrange for this funds and how fast can it pay back? Now, all this together makes the financial strength or the financial well being of an organization. Now, this financial strength and the profitability of the organization is always said to be influenced by the financial structure or the capital structure of the organization. Now, if at all you remember your the balance sheet, when you have studied your accounts, you probably have drawn number of balance sheets. On the left hand side, we do have liabilities. On the right hand side, we have our assets. Now, if you try to remember your left hand side or the total liabilities makes up the financial structure of an organization, because that is wherein we would be writing how many number of equity shareholders we have, what are the debt the organization is having. So that represents your financial structure. Now, it can constitute current liabilities, long-term debts, preference shares, and equity. And that's when we tell that the financial structure includes both capital, short-term as well as long. Now, having said this, what you can take down is the long-term financial strength and profitability of an organization is influenced by financial structure. The financial structure represents the left hand side of the balance sheet, that is the total liabilities, and it consists of current liabilities, long-term debt, preference shares, and equity. And that's when we can tell that financial structure includes both short-term and long-term capitals. Now, if at all you remember, in our first chapter, we had discussed regarding investment decisions and so many elements under that. Now, it is said that for building a capital structure for an organization, we have to estimate what are the funds required. And it goes without telling that a easy estimation of funds requirement can be done by understanding or by evaluating the investment decision. Now, anticipation is done by evaluating the investment decision regarding the finance or the required capital can be easily pondered out by understanding this investment decision. Or in simple words, the necessary combination of short term and long term can be understood by understanding the investment decision of an organization. Now, having said all these things, there are two sources. Basically, one is equity, the second one is debt. Now, the proportion of these two in the financial structure is nothing but the capital structure of an organization. So, what you can take down is generally an organization has two sources of funds. First one equity, second one debt. Now the proportion of these two sources of funds in the financial structure makes the capital of an organization. Now, if at all you need a definition regarding capital structure, now one of the scholars called Vaughan has given a very simple definition which entails the entire meaning of capital structure. I quote, capital structure may consist of a single class of stock or it may comprise several issues of bonds and preferred stocks, the characteristics of which may vary considerably. That is to tell, as we discussed earlier, a single class of stock represent it can be entirely made of any one particular source of fund that we have discussed. That is, well, it can be made either only entirely of equity. It could be made only out of the debt, or it can be also made only of the bonds or the preference shares. Anything is possible. Or the second chance is that it can consist of several issues of bonds and also preferred stocks. And when it is a combination, definitely the characteristics of each would be different from one another. Now, all this you'll understand as we move forward with the chapter. Now, capital structure refers to nothing but, in some other words, it is composition of capitalization. Now, to tell regarding capitalization, it represents nothing but the proportion of debt and equity. Now, in other words, it is also called as capitalization. Now, it can be capitalization, it can be capital structure, it can be capital. All means the same, and it can consist of the debt, equity, or a combination of both. Now there is one simple formula how we can understand what is the capital or how to calculate the capital structure. Now the capital structure is nothing but your long-term debt that your company owes to others along with the entire preferred stock and also your net worth. All this together makes the capital structure. When you see the word net, definitely it means your assets minus the liabilities. That is what makes it net worth. It is not the entire worth but the net worth of an organization. Now, or it can also be said, now it can also be said as total assets minus current liabilities. So those who want to take down, take it down. Now, the next topic is the factors which influence the capital structure. Now, as we said earlier, the capital structure is made up of the components that we already spoke of. Now, when it is a combination, Definitely, there lies behind that some decision regarding whether we going for equity or debt or combination of the things, we'll have to decide, right? Now these decisions would be mainly influenced by many of the factors. Now now these factors can be internal factors, it could be the external factors. Okay. Now, moving forward, I hope now you can see the screen. Now, all that we did was introduction, and there was this definition which was put up. Those who want to take down can take it down. Capital structure may consist of a single class of stock, or it may comprise several issues of bonds and preferred stock, the characteristic of which may vary considerably. Now, moving forward, we had capitalization. Now, capitalization is nothing but the proportion of debt and equity. Now, the formula of capital structure is long-term debt plus preferred stock plus net worth, or it can also be the total assets minus current liabilities. Now, moving forward, the factors which influence capital structure. As we discussed, it can be internal factors, it can be external factors, or sometimes the general factors. Now, all these points I have definitely given in your PPT and handouts also, but the explanation you need to take down. Okay. The first one is cost of capital. Now, cost of capital we have already discussed in our first chapter. Now to remember it once again, Cost of capital is nothing but the expenses the organization has to face or to pay when it brings in the capital for an for its organization for that matter. To put it still more simple, when we give in for equity shares. Now there would be very much expenses that would be necessarily paid. That we'll have to go for the market if it for the first time primary market, and once after we introduce our shares in that, then we it would be traded in the secondary market. Now introducing our shares in the capital market or primary market comes along with many expenses. Now there have to be too many rules and regulations that we have to be abide by. Now there would be some bankers for whom we'll have to pay, and there are many things. Now it is recommended if there are people who have not studied business studies as a subject or who doesn't know this particular topic as to how organization list themselves in the primary market, you just go once and try to read it. It is self-explanatory and you'll be able to understand. But knowing that becomes important why there is cost in having equity as a capital in organization. And when we go in for debt, the cost is nothing but the interest that we'll have to pay. Now this cost of capital, it is not just that we have to understand the current cost of capital, but both the current and the future cost of each of the potential sources of capital should be estimated and should be compared. Now, why is it necessary that we do? That we estimate. So in exact terms we can never tell what is the cost of capital until unless we go in for that we experience it. But the estimation from the past records and the way of the market is working can be made. Now it is not that only the current cost of capital, but also the cost regarding the future capital also will have to be made. Now it is necessary because we first thing we'll have to compare all other types of funds so that we will know which type of the fund would be helpful in using, so that we'll have to experience a minimum cost so that we'll have more profit in hand. That is why cost of capital becomes a factor which influence the capital structure. That when we compare and when we know that they, for example, now that we have done the estimation, we have compared, we might come to a conclusion that for our particular organization, having all other things considered, equity might be less costlier than the debt. So in that case, definitely, after understanding the situation, I as a financial manager, I might recommend my top level management that we try to build our capital entirely on equity. I hope you have taken down the points that uh, were necessary for you. If I have to repeat, the cost of capital is nothing but the expenses that we will have to face in bringing the different kinds of capital, and each kinds of fund will have its own cost. Now, it is expected that both the current cost and the future cost of each type of funds is known, is estimated and compared, so that it would help in taking this decision regarding what the capital of an organization should be made. The next one is risk. Now, risk is nothing but the uncertainty, right? The probability. I have invested, I do not know whether I am going to get back my investment. If I get my investment back, will I get something less than what I have invested? Will it be something equal to that? Will it be more than what I have invested? Now that probability, now that unknown scenario is called as risk. Now ordinarily or in the general terms when we speak of, when there is more debt in an organization, it increases the risk. When the equity is more, excuse me, it reduces the risk. Now, how does that happen? Now, that is to tell, when your organization is made up of debt, then you would be in compulsion to pay back a fixed rate, maybe at a fixed time period. Now, if at all there would be some changes and it would result that you would be unable to pay, then you might have to face difficult situations. But when with equity, what happens is that there is no compulsion that you pay dividend, and this I have said in very general terms through which you can understand it. Now there is detailed explanation and greater complex explanation regarding this. Those who are willing can always refer the library books or the books which has been referred in your syllabus. Now this particular risk can never be estimated to an exact point, but to some extent it can be measured using some of the ratios. Now these ratios are the one thing which you would be also using if at all you select, for when you have to do your project. If you are going for the data from province, most of the time you will be using the ratios. Now there are many types of ratios through which to some extent we can understand the risk. Now you can take down, risk is nothing but the uncertain factors. Now it would have an influence on the capital structure. Now usually it is said that debt decreases the risk and the equity, the debt increases the risk and the equity decreases the risk. Now moving forward, the next one is dilution of value. Now what is this or what might be this? Now imagine an organization which is made fully of equity, and it might have, like, now without giving a mathematical explanation, now it is very simple to understand that the more the number of equity increases, there would be dilution in the value of the company. That is to tell, now if at all the entire capital structure was made up of 100 rupees, and if there were two equity shareholders, Now each share would be of the value 50 each, right? Now we might increase the number of equity. We might issue another two shares of rupees 25 each. So now the entire capital would go in for 150 rupees, but the ownership is now in the hands of four people, right? So two, and that's when the value of the equity becomes diluted. And it is said that a company should not issue any shares which would dilute or no, which would have an effect of removing the value of the shares from the hands of the existing shareholders. In other words, as there is increase in number of equity, the ownership value in each equity starts decreasing. So for this what you can take down is that a company should not issue shares which result in dilution of the value of existing shareholders. The next one is acceptability. Now, acceptability from whom? Acceptability in terms of what? What are we trying to tell here? That whose acceptability would influence a company's capital structure is the question. Now, organization can only borrow funds if the investors are willing to give it for the organization. They can come up with any good idea or any kinds of, probably promotions regarding their organization. But until the investors are ready to or willing to invest, our organization can never borrow it from outsiders. Now that is where acceptability from the part of investor becomes important for an organization. If my potential investors are ready to accept my proposal, then it might there might be chances that I can make my capital wholly out of equity. But if my investors, or if there are no investors for my company, then maybe I will have very less ways how I can build my capital structure. Now that might also severely increase the expenses or the cost that my organization will have to face. And that's how acceptability from the investor becomes important. So you can take down, an organization can borrow only if the investors are willing to invest in the organization. Now the rest things you have to remember and write. That is to tell what happens if they are not ready and how does it affect, and how acceptability is one of the factors. For that matter, we might have seen that there are few companies which offers luxury of the capital structure, and when they have different types of stocks or different kinds of very luxurious funds that they would be using, and such things sometimes might be unacceptable to the financial investors also. The next one is transferability. Now, what is this transferability? How does or what are we trying to tell here under transferability? Transferability to tell in the meaning it is nothing but something has been moved from one to other, right? Here we are telling the transferability of the ownership. Now, especially this happens in the capital structure and the organization's capital is made up of equity and it is being dealt in the capital market. Now, whenever the investors have this option of transferability, or that is to tell when they can buy the shares whenever they need, and if at all the things do change and they do not want, if they can sell it to some other, then they might be willing to invest more in your organization. And that's how the transferability nature of your capitals also influence your capital structure. The next one is increasing owner's profit. Now, this is also one of the internal factors. Now, in the basic aim of the organization, we'll have to think whether it is that we are trying to, increase the owner's profit more, then what becomes necessary that we go in only for the debt, so that when I take debt, once after I pay the interest, whatever remains will be belonging to the owners. But in equity, that is not going to happen. So, the decision regarding whether we have to increase our owner's profit also influence the capital structure. Then next one is surrender operational control. That is to tell, now when there is lesser, when there is equity stock, it results in increasing of operational control in an enterprise. If you want me to repeat it once again, the equity stocks result in increasing of operational control in an enterprise. The next one is future flexibility. Now, whenever we do, whenever might be we have equity, it is not that whatever profit we have, we should give it for the equity shareholders. Now, every organization would maintain a balance of some amount or some finance to ensure that there is future flexibility in the capital structure, and there should also be, as the named as flexibility, it calls in for the readiness to adapt for the future changes. So that characteristic of the organization is also going to influence the capital structure. And one last point in the internal factor is matching fluctuation needs against short-term sources of fund. That is to tell, the short-term sources are one which you can either have, which you can sell, and it is that money would not be invested for a long time in that, or it would be more liquid than that of long-term funds. That's why, the matching these needs against short-term sources also influence the capital structure. So now moving forward, whatever we discussed represent the internal factors. Now the next one is external factor. Now speaking regarding the external factors, now this would be representing the industrial factors, not just the business, but the industry in which the business is set up. Now, which are such factors which influence the capital of an organization? Now, the first one is general level of business activity. Now, whenever the industry is growing, and also on the other hand, whenever our organization is growing or the overall business is growing, then the firm will have to expand its operation so that it keeps on growing and earning more. So whenever that is the case, maybe equity would be helpful for the organization than that of the debt. Or depending upon the nature of the business that is doing, it will also have its own kind of decisions to be made. Now that is to tell, in the initial years and when it is a new company, definitely I as a organization may not be able to pay more, or maybe my profit is zero. But if at all my investors are such that they are willing, you know, to invest, then maybe equity would be helpful for the growth of the organization. So it depends upon you how you would try to analyze these things and how you would put up on your paper. Now the next thing that we can see is the level of interest. So what is this level of interest rate? Which interest are we speaking? We are trying to tell the interest which would be the normal bank interest rate, or which the exists in the economy of a country. Now in any economy where there is interest rate more, or when the interest rate increases, then the firms will decide that they will go in for debt, maybe not as much as if the interest rate were lesser, because when they're going for debt and when the interest rate is more, then you'll be having to pay more out of the organization. So under level of interest rate, what you can take down is, more the interest rate, firms will delay debt financing. The next one is level of stock price. That is to tell the stock price of our organization itself. The more the stock price of our organization, people would have a faith, or the investor perceive that it is a good revenue to invest. So they would be start investing more, and we can rely only on equity, which at times proves to be less costlier than that of debt. The next one is availability of funds in the money market. Now, whenever we go in for debt, definitely we'll rely on money market. Now, this will affect how much debt an organization will have and how much would be the equity. That is to tell, if at all debt as an organization I need debt, and if the money market in which I belong, if it can provide me with the fund, then I as an organization will not go for equity. But if there are limitation to what I can borrow, definitely above that level I'll have to go in for equity. The next one is tax policy on interest and dividend. Now this is not demand. This had to be dividend instead. So please make a note of that. It is not demand, but it is dividend. Now what is dividend? It is nothing but the return the organization pays back to its equity shareholders. Now, although this particular decision regarding how much dividend has to be paid, how much dividend to whom, or for that matter, whether the organization is paying dividend or not. Now, all these things, although the decision is taken by management, it is also one of the factors, which is general in nature, which does affect the capital structure of an organization. I hope you all have taken down. Now, there are some of the general factors which influence the capital structure of an organization. The first one is size of the business and characteristics of the capital requirements. Now, size of the business is nothing but what is the amount that it is dealing it. Whether it is going to have a certain kind of effect on the economy or on the industry for that matter. Now that represents the size of the business. And characteristics of capital requirement, it is nothing but what kind of funds are required by that particular organization to build its capital. Now it can also be seen that even though large firms are having the kind of convertive finance, they issue new securities to the public. Now, they even though they have enough funds, they do this in a case if a company is especially successful and it is rapidly willing to issue bonds and preferred stocks without diluting the equity stock, because we can issue preferred stocks and bonds, and when that happens, people with the hope that the business is doing well, they are definitely going to invest. And also on the other hand, there would be no any kind of dilution in the value of the firm either. And one more scenario of the business we can see is that some of the organization, they might be having rapid growth, but then their current earnings might be low. And in such cases, the sale of equity will not be desirable, because since there is no earnings, people might hesitate to invest. But then, even in such cases, if at all the assets are plenty, now the borrowings is possible. Now, then there are also chances that there can be traditional way of issue through the way of mortgage bonds. By all this encourages borrowings by financial institutions or heavy investments in fixed assets. Now, these are some of the things which influences the characteristics of capital requirements in an organization. Now, hopefully, you have taken down. Now, these points are very, very random. That is, there is no link between. But these are the points which you can take down under this. That is to tell size and characteristics of capital structure. The first one you can take down is when there is a large firm, even though it has enough funds, but if at all it is doing a successful business, it can go in for new securities. And it is not necessary that it goes only for security, but if at all the investors are very much you know pretty sure that the company does very good and has a kind of faith in the organization, instead of diluting the ownership by giving equity, the organization can also go for some kind of bonds or debt. And also now there is as opposite to this situation, there is a situation wherein our organization may be facing rapid growth, but the current earnings might be low. Now in such case, the sale of equity is not desirable, but then if the assets of the organizations are plenty, then borrowing would be possible. Now, so much is the next character, general factor is one is the growth rate, the age of the organization, and also the size of the firm. That is to simply tell that capital structure differs at various stages of development. Now, what happens is when a business is very successful from the beginning, in its earlier years, there would be rapid development, and the principal source of fund would be the equity capital and short-term capital, because this happens mainly because the organization would be very successful, and also people would be ready to invest. And when that is the case, what happens is earnings improve, and reinvestment in lendings would be done, and long term debt will also be taken by the organization, so that would constitute the additional capital. Now, whenever the firm goes again in size, there would be internal expansion required the retained earnings usually replaces the bonds and debts. Now, in each field, this particular thing is different or varied by size of the company, and the equity ratios tend to vary directly with the size of the organization. Now, if at all you want, you can take down points. That is, capital structure differs at various stages of development. You can take down in words, not in sentences, where you can write if it is an early year of business and if it is successful, the capital would be made up of equity and short term. Then when the earnings improve and the people have more faith in an organization, the organization goes in for reinvested lendings and long-term debts, and this would add to the addition of types of funds or capital. When the firm grows in size, the internal expansion also happens, and the retained earnings is usually replaced by bonds and debts. And in every field, it is said that the growth is varied by the size of the company, and the equity ratios tend to vary directly with the size of the organization. The next one is operational characteristics. Now it goes without telling. Now before that, operation represent the activities of the organization, right? Now each business differs in its operational characteristics, and because of this reason, it also differs in the needs for the fund. Now, to give an example, we can take example of two different kinds of organization. One which produces merchandising products or goods. Other which produces public utilities. Now, when we took the example of merchandising firm, usually such kind of business operates on small margin of gross profit, and mainly they do business with current assets. And on the other hand, we have public utilities, which has small gross income. Now they have small gross income when we compare it to their capital income, and which requires huge capital invested or extensive capital investment. Now merchandising, we can take the example of a soap manufacturing company, and for public utilities we can take example of a company which constructs dam. With a merchandising, they have small margin on their gross profit. Yes, and they do mainly deal with current assets. But when it comes for public utilities, their gross income would be less compared to what amount they would be investing in their capital. The next one is continuity of earnings. Now, This continuity of earnings is marked by the characteristic of the stable earning or organization can, excuse me, sorry. Now this continuity of earnings is marked with the stable earnings an organization can have. Now this can be handled by recurring fixed charges. Now non-durable consumer goods, it usually enjoys stability of demand and rigidity as compared to durable consumer goods. Now that is to tell, when you compare, maybe a consumer goods or a non-durable consumer goods with a durable consumer goods. Now the non-durable consumer goods will enjoy stability of demand. That is to tell, there is a continuous demand. But for the durable consumer goods, as compared to that of non-durable, there might be no particular stable demand. And when there is less stability of demand, there would be less stability of earnings. Now, the earnings of some individual companies, they are fairly regular, though which may suffer from changes in economic condition. Now, the nature of earnings should be guiding principle in determining the capital structure. That is to tell, if my earnings are stable, maybe I can go for debt, fund which I can easily avail from the market. But if my earnings are not stable, then maybe I have to go for equity alone. The next one is flexibility. Now, flexibility is nothing but the ability to change, being flexible, change according to the situation. Now, to have compare this, the flexibility, we can tell it in terms of by giving an example of one organization or a company A which has been financed very much with no problem, which has conservatively financed or which has too much of amount in its hand for the disposal. Now on the other hand, we can also take company B which is hugely mortgaged or which has too many loans in its own name. Now the company A which is conservatively financed, it would fairly carry a less small debt, and the one company, that is company B, which is heavily mortgaged, it cannot be or it will not be able to choose from among the different financial alternatives available to it. But then the company which has been severely mortgaged will have to get funds from whatever means is open to it. Now the nature of capital structure is influenced by a struggle to maintain the managerial control. Now if a wide spread of ownership is desired, it is assumed that a firm will have additional stock. But if it likes the ownership to be in very less few people, then it might go in for debt. Now all these are the things that you can speak under flexibility. Now moving forward, the sixth one is marketability of securities. Now this is the actual thing which influence the capital structure if we see in the practical way. Now the more the rate the securities has in the market, people would be interested in investing in that, and less the marketability of the security, they would be willing to invest in this. Now the corporation watches changes in the market, and this also happens because of the psychology of the investors, and because of that they consider the marketability of the securities very carefully in planning new securities. Now, not only this, when we speak about market ability, there are many things. How the general economy is there, what the people pursue, and whether they are willing to invest. Not only that, the general economic condition also matters in case of this. The perception, the attitude of the investors. So marketability of securities will have a great influence on the factors which influence the capital structure. The next one is government influence. Now speaking regarding this, the tax is the one thing of the government which influences the major decision of capital structure. Now this happens because corporate income tax is the one, when it is more, it reduces the net earnings of the capital, and the debt financing encourages because of income tax leverage. So I hope you know what is this scenario. So the thing is, when we speak about government influence, here especially we mean by the tax. Now what happens is that there would be something called as corporate tax. Now when the organizations earn everything, definitely the tax could be 1% or 50%. The moment we have to pay tax, it reduces the net earnings of the company. But then, when we have dividend or the debt, or when we pay interest, there are also chances that it encourages debt financing, because of there is something called as tax leverage when we go in for debt as a capital in our organization. Now, how that is going to happen, we can see it through the help of an example, which I would be telling later. Okay. Now, actually, what happens in the case is that now the tax has to be paid. Uh, you know, No, let me explain that along with the example later. Now, just remember that government influence is mainly because of the corporate tax, and when there is corporate, this tax definitely decreases the net earnings of an organization. And when we compare two things, the debt and the equity, the more the tax that is there in the economy, people would go in for debt type of financing. The next one is financial leverage. Now this financial leverage is nothing but the borrowed funds in the purchase of an assets. Now to tell that, unfavorable financial leverage usually indicates low profitability, and because of the low profitability, it makes the borrowings more costly than the return of investment which is expected. Now it is difficult for a firm to issue additional stocks when profits are low, and it also decreases the alternative available. Now what you can take down is, regarding the unfavorable financial leverage, because unfavorable financial leverage is one thing which reflects the fact that the company is less profitable. And when people perceive that it is less profitable, definitely they are not going to invest in your organization, and it makes the borrowings more costly than the return of investment. Now it is difficult for a firm to issue additional stocks in such cases. The next one is market price of equity stock. Now it made Now, this speaks against the favorable financial leverage. Now, if the overall cost of capital is low, it is likely that equity stockholders may assume that the firm cannot afford to pay a higher cost of capital, and therefore, might be the company's earning low. Now all these are very technical things. You'll have to understand it. Now the marketability price of equity stock, it speaks against the favorable financial leverage. Now if the overall cost of capital is low, there are chances that equity stockholders may perceive or assume that the firm cannot afford to pay a higher cost of capital, and that's why they are earning low income. Now, if the cost of capital is high, it can be assumed that the firm cannot exploit, the different kinds of profit opportunities that an organization is having. Now, both the things simply means that as an organization they can always try to take benefit of that, but it always depends upon how the people would be perceiving it. Now, it simply means the behavior of equity stockholder in the market is usually unpredictable in nature. Now, as we discussed, one more thing is corporate structure. Now, the corporate structure affects the internal changes and are deductible, and the use of debt securities provides a lower cost of financing than preference shares or equity. The same thing what we discussed under government influence is nothing but we are speaking under corporate taxation. Now, government influence you can also take down because of some of the policies, some of the new rules and regulation. It might also affect the capital structure, or if at all it decided to increase the bank rate, interest rate, how it is going to affect also you can speak of. In corporate taxation, what happens is the more the rate of the tax would be, then it is advised that we go in for debt. Now, why is it said we shall try to understand by understanding this particular example? Now, just try to concentrate on this particular example wherein there are two different situations. Okay. Now, one particular project, it requires, now this particular project requires 5 lakh rupees, and now it requires lakhs rupees for investing in one particular project. Now the organization has two alternatives. Alternative 1, where it can bring this 5 lakh rupees in a way of debt, and that particular debt will be bearing 6% of interest. That is to tell, if I bring in debt, then to what extent I bring the debt, 6% of interest I will have to pay back. Now that would be the charges for bringing in the capital that I require, or that is the cost, right? A part of the cost of capital it represents. Now that is the first alternative. Or I do have a second alternative where I can bring the required necessary capital in the form of preference stock. Even the preference stock here is bearing 6% of interest on the face value of the shares. Now both are same project, but then I have two alternatives through which I can manage to raise the fund. Now this represents the amount that has been invested. Now we shall see each of the alternative in a very general term, and we shall try to understand why debt becomes sometimes more preferable, sometimes more favorable than that of preference share. Now, to decide, we should have something, right? Basis on which we can decide. We can decide on the basis of the earnings available to equity shareholders. Now, that is the main thing our investor sees, right? What do I earn? What is the return on investment? Now, that might be a scale on which we decide. Now, because this is an example, we have considered that the earning before both interest and tax would be 12% on the project outlay. So 12% on 5 lakh would be 60,000 each. Now, we have a component which is earning before interest and tax. From that, first we are going to pay the interest that we will have to give in for the debt that we have bought, right? So, interest at 6%. 6% on 5 lakh is nothing but 30,000. That is in first scenario. In case of second scenario, since it is preference stock, we are not going to pay any kind of interest. What we are paying is dividend for a stock. It is not the interest. So in second case, there is no any interest being paid. Therefore, the earning before tax in the first case becomes 30,000 and in the second case it becomes 60,000. Now, the earning before tax that each in the organization has in each case is, in the first case it is 30,000, in the second case it is 60,000. Now, earning before tax represent that we'll have to pay tax. So, usually when the taxes is not going to give, the general corporate tax will have to be assumed, and when you are doing with the problem, you will have to give a note telling that since the rate of interest has not been mentioned, or since the tax rate has been not mentioned, we have taken the general rate that has to be paid by any corporate organization. So here in this case we have taken tax at 40%. See the change what now has happened. Because under first scenario, the company had already paid interest, the earnings it had in its hand was less compared to that of the scenario wherein it did not go for debt but had preference stock. Now, here the tax would be 12,000 for the first scenario, that is 40% on 30,000, and 24,000 represents 40% on 60,000. And because of this, the net income after tax would be 18,000 for 6% debt and 36,000 for preference stock. But whereas in the second scenario, the company has yet to give the stock dividend and it would be given at 6%. Okay. Okay. Now, please see when it is a tax and you had 40% tax, you will have to pay on the earnings before tax. So, 30,000 into 40% will be 12,000. When it is preference stock dividend at 6%, here the 6% will have to be paid on the 5 lakh, the amount that you had brought as capital. So this is nothing but 6% into 5 lakh, the amount what you had brought as capital. So 5 lakh into 6% would be 30,000. Now see what is remaining in the hands of the organization to give to its investors. When they had used debt, they would be having 18,000, and when they have preference stock, they are having 6,000. So definitely people will go in for debt. Yes. Now, having said this, uh, the next topic is optimum capital structure. Now, before telling this optimum capital structure, now this is something which is along with the capital structure, but a further complicated version of capital structure. Now, there is nothing to worry, but only that you have to remember. So maybe we have spoken too much for today, and we do can stop it at this particular point, and we shall continue with the optimum capital structure in the coming session, which would be in the Tuesday afternoon from 2 to 4. Now those who are interested can come for offline classes which are provided with all the different measures that you have to take. Now, having said that, I do really hope that you have started maintaining notes and you have taken down points. Because when I give you PPT, the PPT would be simply this. You might get the questions would be there, the answer would be there, but you would not know from where it has come. Because, see in the case here, of the preference dividend itself. In each step, we have taken the percentage on the above. Now that is interest on 6%, we had taken on 5 lakh. But when it came here for 30,000, for once we will be confused as to how 6% on 36 would be 30,000. Because here 6% would be on the preference stop. So that's why I asked you to maintain a notes. Now the next topic would be capital structure, which we shall you know discuss in our coming session. Now, thank you for your patience in listening. I had taken it at a strength. Maybe when we'll have to deal in the same chapter with the practical problems, we'll have to take it a stretch. So please be used to that and try to, you know, uh, once after knowing, once after listening, please do not keep it just like that. Once you shut your computer or laptop, try to understand what we have already studied. Yes, thank you class. Your attendance anymore would be automatically recorded, and yeah, that also tells me that for your theory part, unless I have at least 50% either online or those who would be coming to class, I would not be giving you any kind of handout. So you decide whether you'll come and sit, you'll listen or not. Thank you, and you can leave the meeting for the day.